Options are financial instruments that provide investors with the right, but not the obligation, to buy or sell an underlying asset at a predetermined price within a specific time frame. This flexibility makes them attractive for various trading strategies, including hedging, speculation, and income generation. Understanding how options are priced and the factors that influence their value is crucial for making informed trading decisions. In the Indian market, options are traded on major exchanges like the National Stock Exchange and the Bombay Stock Exchange. They are available on a wide range of underlying assets, including stocks, indices, and currencies. The price of an option, known as the premium, is determined by various factors, including the current price of the underlying asset, the strike price, time to expiration, volatility, and interest rates. This essay will delve into the intricacies of option pricing and explore the role of option Greeks, providing insights into how these factors interact to influence option premiums. By understanding these concepts, traders can make more informed decisions, manage risk effectively, and potentially enhance their trading profits. Intrinsic value forms the bedrock of understanding option pricing. It represents the inherent worth of an option based on the relationship between the strike price and the current market price of the underlying asset. For call options, intrinsic value is the difference between the market price of the underlying asset and the strike price, if that difference is positive. Otherwise, the intrinsic value is zero. Conversely, for put options, intrinsic value is the difference between the strike price and the market price of the underlying asset, if that difference is positive. Otherwise, it is zero. To illustrate, let's consider Reliance Industries stock trading at 2,500 rupees. A call option with a strike price of 2,400 rupees would have an intrinsic value of 100 rupees. This is because the option holder can buy Reliance Industries stock at 2,400 rupees and immediately sell it in the market for 2,500 rupees, making a profit of 100 rupees. On the other hand, a put option with the same strike price would have an intrinsic value of zero, as exercising the option would result in a loss. Understanding intrinsic value is essential for evaluating whether an option is in the money, at the money, or out of the money. In the money options have a positive intrinsic value, while out of the money options have zero intrinsic value. At the money options have a strike price equal to the current market price of the underlying asset. While intrinsic value provides a tangible basis for option pricing, it only tells part of the story. The remaining portion of an option's premium is attributed to time value, a more elusive concept that reflects the potential for the option to gain value before it expires. Time value is influenced by several factors, including the time remaining until expiration, the volatility of the underlying asset, and interest rates. The longer the time until expiration, the higher the time value, as there's a greater chance for the underlying asset's price to move in a favorable direction. Similarly, higher volatility increases time value as it implies a wider range of potential price movements. Interest rates also play a role, with higher interest rates generally leading to higher time value for call options and lower time value for put options. Time value is a crucial consideration for option traders, especially those selling options. As an option approaches its expiration date, time value decays, eroding the premium received by the option seller. This decay accelerates as expiration nears, making it essential for option sellers to carefully manage their positions. To navigate the complexities of option trading, traders rely on a set of risk measures known as the Greeks. These Greeks, represented by Greek letters, quantify the sensitivity of an option's price to changes in various underlying factors. Understanding the Greeks is essential for managing risk, predicting price movements, and developing effective trading strategies. The most commonly used Greeks include delta, gamma, theta, vega, and rho. Each Greek provides insights into how an option's price will react to changes in factors such as the underlying asset's price, volatility, and time decay. By understanding these sensitivities, traders can make more informed decisions about which options to trade, how to manage their positions, and how to hedge against potential losses. The Greeks are dynamic and constantly changing as market conditions evolve. Therefore, it's crucial for option traders to continuously monitor these measures and adjust their positions accordingly. By effectively utilizing the Greeks, traders can gain a deeper understanding of option pricing dynamics and make more informed trading decisions. Section 5. Delta, measuring price sensitivity. Delta, represented by the Greek letter delta, is one of the most fundamental option Greeks. It measures the sensitivity of an option's price to changes in the price of the underlying asset. Specifically, delta represents the estimated amount an option's price will move for every 1 point change in the underlying asset's price. For example, a delta of 0.5 suggests that for every 1 rupee increase in the price of the underlying asset, the option's price is expected to increase by 50 paise. Conversely, a delta of minus 0.5 indicates that for every 1 rupee decrease in the underlying asset's price, the option's price is expected to decrease by 50 paise. Delta values range from -1 to 1 for options. Call options have positive delta values, while put options have negative delta values. The closer an option is to being in the money, the closer its delta will be to 1 or -1, depending on whether it's a call or put option. Conversely, the further out of the money an option is, the closer its delta will be to 0. Alright, let's dive into understanding the rate of change. In the world of options trading, the rate of change is crucial. It helps us gauge how the price of an option will move in relation to the underlying asset. This is often referred to as the option's delta. Delta measures the sensitivity of an option's price to a 1-unit change in the price of the underlying asset. For instance, a delta of 0.5 means the option's price will move half a unit for every 1-unit move in the underlying asset. Understanding delta is key to predicting how your options will perform. Now let's talk about the relentless march of time decay. Time decay, or theta, represents the rate at which an option's value decreases as it approaches its expiration date. It's a crucial concept because, as time passes, the potential for the option to be profitable diminishes. Essentially, theta quantifies the impact of time on the option's price. The closer you get to the expiration date, the faster the value erodes. This is why it's important to consider the time remaining when you're planning your trades. Next, navigating volatility and interest rates. Volatility, represented by Vega, measures how much the price of an option is expected to change as the volatility of the underlying asset changes. High volatility means higher option prices, while low volatility results in lower option prices. Then, there's the impact of interest rates, often denoted by ρ. ρ measures the sensitivity of an option's price to changes in interest rates. An increase in interest rates generally leads to higher call option prices and lower put option prices. Understanding Vega and RO can help you make more informed decisions in your trading strategy. Finally, let's discuss practical applications and wrap things up. By now, you should have a solid understanding of the key Greeks: delta, theta, Vega, and ρ. These metrics provide invaluable insights into how options are priced and how they will behave under different market conditions. Applying this knowledge can significantly enhance your trading strategies, helping you to manage risk and optimize returns. Remember, the more you understand about the dynamics of options, the better equipped you'll be to navigate the complexities of the market. Thank you for joining us and happy trading.